please, I'm begging you, do not use historical rates of return to project future investment returns. Please. So my man has sent me the Vanguard, the Vanguard portfolio allocation models. I forgot who sent this to me, but whoever did, muchos gracias, as we say in the Spanish-speaking countries, of which I am part of. I'm not just being funny. I love the Spanish language. I wish I could see it, speak it for sure. Anyway, so Vanguard portfolio allocation models. We're going to look at income. An income portfolio consists primarily of dividend-paying stocks and coupon-yielding bonds. If you're comfortable with minimal risk and have short to mid-range investment time horizon, this may suit your needs. All right, 100% bonds. This is 100% bonds. All right, everybody's seeing this. Historical risk return. Average annual return 6.1. 100% bonds. Average annual return 6.1. If you're using 6.1% in a 100% bond portfolio, I have a bridge to sell you in Brooklyn and oceanfront property in Arizona. I'll sell them cheap to you too. This is freaking nuts, man. This is nuts. So let's just, this is freaking insane. 2080, 7.2%. If you're using historical rates of return with a 7.2 with 80% bonds, I have a bridge in Brooklyn and some waterfront property in Arizona. And some desert in Maine. They might be someplace of desert in Maine. I don't know. Anyway, so I'm going to show you guys something. So I want to show you the daily treasury yield curves starting the most recent. 1.9 is September. This is insane. September 2021, 1.9. You could lock in 30 years of government bonds to get 1.9%. You could lock in 10 years of government bonds to get 1.29. I'll show you what I just had before that. We'll go back to 2018. What did we have in 2018? Oh, my lands, we had 2.81. All right, so there's 90 basis points lower than higher in 2018 than it is now in 2021. That's nowhere near 6%. That's a 30-year bond. Here's a 10-year, 2.46. Oh, let's go back to 2015. No, I'm doing 14, doesn't matter. 2014. 3.92. So we've seen the 30-year treasuries dropped from 3.92 all the way down to 1.92. It's dropped 200 basis points. Even back then, you weren't getting 6.21. It wasn't any close. All right, let's go back to 2008-6, shall we? 2006. What were we getting on the 30-year? They got rid of the 30-year, I remember, for a couple years. But we had 10-year at 4.37. All right, let's go back to 2002. What were we getting on the 30-year? And let's take a gander, 5.56. And that's on a 30-year bond. The 10-year was 5.2. The only way to get that kind of return on bonds, it literally cannot happen. It's an impossibility. Unless you sat there on cash and wait for the interest rates to go back up to 6, and then you could lock in a 30-year bond. But if you're in bonds now and the interest rates go up to 6, your goose is cooked, because we know what happens to the price of bonds as the interest rates go up. It's just that simple. So if you're using 6.21 in your bond portfolio, 6.1, you're freaking nuts, man. Don't do that. So let's see what Vanguard, it's insanity. And people are using this. Average rates of return, historical rates of return. And here we go back to Dave Ramsey. 100% stocks, I got 10% on good stock funds. That's freaking 10 to 12%. I simply can't believe people are using these numbers, project forward. So I want to show what Vanguard's doing. So U.S. equities, our annual, let me make this a little bit bigger. Our annualized nominal projections, that's before inflation, as of March 30th, are shown below. Please note the figures are based on 1 point range around the rounded 50th percentile. So they're basically saying 2.6 to 4.6 on stocks. That's nominal before inflation. I think they got inflation 1.25 actually. Yeah, inflation right there, 1.4 to basically 1.75 is inflation. So we take, what's that, 3.6 minus 1.75. I don't have my calculator. Do I have my calculator? No, I don't. So 3.6, let's just say it's a 2%? Less of 1.8% real return on stocks? So then we look at bonds. 1.4 to 2.4 was a 1.75 minus inflation. No return on bonds? It's freaking insanity. And yet, are they using that in their portfolio models, their Vanguard Capital Models, VCMM, Vanguard Capital Markets Models, VCMM. That's what they're using projecting. Is their financial planning do that? I don't know. So let's look at Schwab. See what Schwab's using. This is perfect. Total return equals price growth plus dividend and interest income. What I always say, I've said that since I started. I've said that for years, decades now, because that's based on the Jack Bogle from Vanguard Models. Your capital return assumptions are year-over-year earnings growth plus increases plus dividend yield. That's it. It's just that simple. So Schwab is sitting there saying, what's that, 6.6? And it's awful hard to see that. Can I click on that? No, it's awful hard to see. But 6.6 on U.S. large cap stocks, of which 4.5 is coming from, I can't tell if that's growth, and 2.1% income, I guess. I can't really tell. But anyway, 6.6 on large caps, 7.1 on small, 6.5 on international. I can't even tell what that is. And I can't tell what these other two things are. Anyway, so I wonder if they show fixed income here. Let's see. Do they show any fixed income? I'll put a link in the show notes. You guys can look at this for yourselves. But I mean, if you're using, 1 second, they don't show anything for fixed income. If you're using historical rates of return, you're not only are you going against Vanguard and the Schwabs and your old buddy Josh, but it's fanciful. I really believe that's not financial planning. That's projecting what you want to see happening. And I don't know how you can make that, especially when it comes to any kind of fixed income. If you want to use it for stocks, fine. I can't argue. I mean, I think it's crazy, but if you want to use that's fine. If you're using historical rates of return on bonds, I simply don't know what to say to you. That's just bad planning. And certainly if you're a professional in this business and you're using that, or if you have a guy you're hiring and he's showing you historical rates of return on bonds and projecting that future, man, run, don't walk, run for the door immediately. All right, love to hear your thoughts. We'll see you.